Hi, my name is Cort Gwon from HudsonView Capital Management, and welcome to this week's Wall Street Lingo. This week we're going to talk about the term merger, or mergers and acquisitions known on Wall Street. A merger is a combination of two companies that merge into one, where they think that one company can grow faster than the two companies individually. Now, a merger can be friendly or it can be hostile. A friendly merger is when management, which is the CEO and the CFO and even the boards of the companies, agree. They agree to merge and they agree on the terms of the merger. A hostile merger is when the acquirer, who's the bigger company, attempts to buy the target company, which is the smaller company, but the target doesn't quite agree to the terms that the acquirer offers the target. Now, in terms of a transaction and how it's paid, how a merger is paid, an acquirer can use cash, it can use stock, or a combination of both. If it's a cash merger, the acquirer can take cash off its balance sheet, which it might have, in the bank from regular business to pay for the target. The cash could come from a bank loan. They could go to an investment bank and borrow it. Or the cash could come from the capital markets, where they would issue bonds to raise cash to pay for the target. In a stock-for-stock transaction, an acquirer would issue shares of its own company, new shares, to pay for shares of the target company in some sort of agreed ratio. And then a combination, obviously, is a combination of stock and cash. Now, why do companies merge? Well, there are a few reasons. The first and foremost is growth. A company believes that it can grow faster by acquiring than to start a new business on its own. So an acquirer would go after a target because the target has an existing business and the acquirer doesn't have to start that business from scratch. The second motive is synergies. When companies merge, there's a lot of overlap, and so they can eliminate that overlap, which are costs that they can eliminate, and that would help their bottom line or their earnings. The third is market share. The acquirer, in taking a target, could increase its market share of its products from, say 20% to 25%, and be able to sell the products of the target through its distribution channel. So that's basically what a merger or an acquisition is. And so hopefully that the next time you hear the word merger in the news, you'll better understand what that means. My name is Cort Gwon, and this has been this week's Wall Street Lingo.